Preparing for a finance manager at PKP interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about your experience and why you want to become a finance manager at PKP. I have built my experience across financial reporting, budgeting, management analysis, and process improvement. I now want a finance manager role where finance directly supports a large, operationally complex business. PKP interests me because transport requires reliable controls, long-term investment discipline, and clear performance visibility. I would bring a hands-on style, strong stakeholder communication, and a focus on turning financial information into decisions. My goal would be to improve forecast quality while maintaining accurate, timely, and compliant reporting. While answering, connect your accounting, planning, reporting, leadership, and business partnering experience to PKP's operational scale, infrastructure environment, public accountability, and need for disciplined financial decision-making. Question 2. What are the most important responsibilities of a finance manager? A finance manager protects the quality of financial information while helping the business make better decisions. I would oversee reporting, budgeting, forecasting, controls, cash visibility, and compliance, but the role is broader than producing numbers. I would challenge assumptions, explain variances, identify risks, and support operational leaders with practical recommendations. I would also develop the team and improve processes. Success means finance is accurate, responsive, and trusted by management rather than viewed as a back-office function. Make sure to cover accurate reporting, budgeting, forecasting, controls, team leadership, stakeholder support, cash management, compliance, and translating financial data into commercially useful recommendations. Question 3. How would you prepare an annual budget for a large transport organization? I would begin with strategic priorities and translate them into operational drivers, such as passenger volumes, service levels, staffing, energy, maintenance, and capital projects. I would analyze historical run rates, contractual commitments, inflation, and known regulatory changes. After collecting submissions, I would challenge assumptions with department leaders and prepare base, upside, and downside scenarios. Once approved, I would establish monthly ownership, variance thresholds, and reforecast triggers so the budget remains a management tool rather than a static annual document. In your answer, talk about strategic alignment, operational drivers, historical analysis, inflation, labor and energy costs, capital expenditure, stakeholder challenge, scenario planning, approval, and monthly monitoring. Question 4. How do you build a reliable financial forecast? Reliable forecasting starts with identifying the business drivers behind revenue, costs, cash flow, and capital spending. I would combine historical trends with operational data and obtain assumptions directly from accountable managers. Each forecast would clearly distinguish committed costs, likely outcomes, and management judgment. I would compare forecasts with actual results, investigate recurring errors, and update assumptions through a rolling process. I would also present a range of outcomes, because precision without transparency can create false confidence. Be sure to mention driver-based forecasting, actual to budget analysis, rolling updates, input ownership, assumptions, scenario analysis, data quality, and transparent communication of uncertainty. Question 5. Describe how you would analyze a significant budget variance. I would first validate the underlying data and determine whether the variance is real, timing-related, or caused by coding. Then I would separate price, volume, mix, productivity, foreign exchange, and one-off effects. I would discuss the result with the responsible manager to understand the operational cause, quantify whether it will recur, and assess the full-year impact. My report would distinguish explanation from action, such as renegotiating costs, changing schedules, or updating the forecast. Focus on separating price, volume, timing, mix, exchange rate, and one-off effects. Validating data. Identifying root causes. Assigning ownership. And recommending corrective action with quantified impact. Question 6. What financial controls would you consider essential at PKP? I would prioritize controls over purchasing, payments, payroll, revenue recognition, fixed assets, journals, and bank activity. Core safeguards would include segregation of duties, delegated approval limits, supplier validation, purchase order compliance, account reconciliations, system access reviews, and independent journal approval. I would also monitor unusual transactions and ensure evidence is retained for auditability. Controls should be proportionate to risk and embedded in workflows. I would test their operation periodically and remediate weaknesses with clear owners and deadlines. Mention segregation of duties, approval limits, procurement controls, reconciliations, journal review, access management, fraud prevention, asset controls, audit trails, and periodic control testing. Question 7. How would you manage the month-end close process? I would establish a close calendar with named owners, deadlines, dependencies, and review points. Key activities would include revenue and expense cutoff, accruals, payroll, fixed assets, provisions, bank reconciliations, intercompany matching, and balance sheet substantiation. I would use materiality thresholds to focus review effort and maintain an issues log for unresolved items. After each close, I would analyze late adjustments and recurring bottlenecks. That feedback helps shorten the cycle while improving accuracy in management reporting. In your answer, cover a detailed close calendar, reconciliations, accruals, cutoff, intercompany balances, review controls, materiality, issue escalation, and continuous process improvement. Question 8. How do you ensure accurate management reporting? I would start by defining consistent metrics, reporting hierarchies, and ownership for every key number. Management reports should reconcile to the general ledger, with automated validation checks for totals, periods, and unusual movements. I would present actuals, budget, forecast, prior year, and concise variance commentary, separating facts from interpretation. The format should support decisions, not overwhelm users. I would also control versions and obtain business owner confirmation before release, preserving both accuracy and credibility. Discuss consistent definitions, reconciliations to the general ledger, KPI ownership, automated checks, clear commentary, materiality, version control, and tailoring reports to management decisions. Question 9. How would you improve cash flow forecasting? I would build the forecast from expected cash receipts and disbursements rather than simply applying a historical percentage to profit. Important categories would include passenger or customer receipts, suppliers, payroll, taxes, debt service, grants, and capital expenditure. I would involve treasury and operational owners, reconcile forecasts against bank movements, and track forecast accuracy by category. Weekly short-term visibility can be combined with a longer-range rolling forecast, with downside scenarios highlighting liquidity actions early. Make sure to cover receipts, supplier payments, payroll, taxes, debt service, capital expenditure, working capital assumptions, timing accuracy, scenario analysis, and reconciliation to actual cash movements. Question 10. Tell me about a time you improved a finance process. In a previous role, the month-end close was delayed because departments submitted inconsistent spreadsheets and supporting evidence. I mapped the process, identified duplicate reviews, introduced a standardized template, and created a close tracker with automated completeness checks. I trained budget owners and set escalation rules for late submissions. The close became 2 days faster, late adjustments fell materially, and audit queries decreased. The key lesson was that sustainable improvement required process ownership and user adoption, not only a better spreadsheet. Use a structured example covering the initial problem, root cause analysis, stakeholder involvement, technology or control change, measurable result, implementation risk, and lessons learned. Question 11. How do you manage and develop a finance team? I set clear responsibilities, deadlines, quality standards, and escalation routes so team members know what ownership means. I delegate outcomes rather than isolated tasks, then use regular one-to-ones to coach technical judgment and communication. During peak periods, I balance workloads and maintain review controls instead of relying on excessive overtime. I give direct, timely feedback and create development opportunities through rotations or project work. A strong team should operate independently while escalating risks early. Talk about clear objectives, role clarity, coaching, delegation, technical development, feedback, workload planning, succession, accountability, and maintaining quality during peak reporting periods. Question 12. How would you handle a disagreement with an operational manager about financial results? I would first understand the manager's operational perspective and confirm that we are using the same definitions, period, and data source. I would then separate verified facts from assumptions and explain the financial impact in business terms. If the disagreement remained, I would agree on the underlying objective, such as service reliability or cost control, and evaluate alternative actions against it. I would document the conclusion and escalate only when material risk, policy, or accountability required senior intervention. Mention listening first, checking definitions and evidence, separating facts from assumptions, explaining financial implications, seeking a shared objective, documenting resolution, and escalating only when necessary. Question 13. What is your approach to capital expenditure appraisal? I would assess whether the investment supports strategic, safety, regulatory, or operational objectives before reviewing returns. The analysis should include upfront cost, implementation timing, maintenance, replacement, operating savings, revenue effects, and residual value. I would calculate NPV and IRR where appropriate, use payback as a supporting measure, and test sensitivity to demand, inflation, delays, and cost overruns. After approval, I would compare realized benefits with the original business case, improving future investment decisions. Cover strategic fit, total cost, cash flows, NPV, IRR, payback, sensitivity analysis, implementation risk, operating benefits, lifecycle costs, funding constraints, and post-investment review. Question 14. How do you assess financial risks in a business like PKP? I would maintain a finance risk register linked to the organization's broader enterprise risk framework. Risks could include demand volatility, energy and labor inflation, liquidity pressure, funding changes, project overruns, supplier failure, fraud, cyber incidents, and regulatory noncompliance. For each, I would assess probability, financial impact, early warning indicators, mitigation, and accountable ownership. I would review the register regularly with management and use scenario analysis to quantify severe but plausible outcomes, ensuring risks influence decisions rather than merely appearing in reports. In your answer, discuss risk identification, probability and impact, liquidity, cost inflation, demand, funding, compliance, cyber threats, project overruns, mitigation owners, monitoring, and escalation. Question 15. How would you prepare for an external or internal audit? I would prepare early by reviewing prior findings, confirming the audit timetable, and assigning owners for every requested schedule and control document. Before fieldwork, I would ensure reconciliations, supporting evidence, policies, and management judgments are complete and internally reviewed. During the audit, I would respond factually, maintain a request tracker, and escalate potential issues promptly rather than allowing surprises. Afterward, I would agree practical remediation plans, address root causes, and monitor completion with evidence. Be sure to mention audit planning, evidence quality, account reconciliations, control documentation, schedules, issue tracking, timely responses, independence, and remediation of root causes. Question 16. What would you do if you discovered a material error after reporting had been issued? I would verify the error, quantify its gross and net impact, and determine whether it affects reported statements, management decisions, covenants, tax, or compliance. I would inform my manager and relevant control, audit, or governance contacts promptly, following the escalation policy. I would not conceal or postpone a material issue. We would agree the correction, disclosure, and communication approach, document the judgment, and perform a root cause review so the process or control is strengthened. Focus on verifying materiality, preserving evidence, informing appropriate stakeholders, assessing accounting and control implications, correcting transparently, documenting judgment, and preventing recurrence. Question 17. How do you use technology and data analytics in finance? I use technology to improve control, speed, and insight rather than automate poor processes. An ERP should provide consistent master data, approval workflows, audit trails, and reliable general ledger integration. I would use dashboards and exception reports to identify unusual costs, late transactions, aged items, or forecast changes. Automation can handle reconciliations and recurring reports, while finance retains review over estimates and judgment. I would also validate data lineage, restrict access appropriately, and monitor automated outputs. Discuss ERP discipline, automation, dashboarding, data validation, exception reporting, workflow controls, reduced manual effort, access security, and maintaining human review over judgmental decisions. Question 18. How would you manage finance during a major restructuring or transformation? During transformation, I would protect business continuity first. Accurate close, cash visibility, payroll, compliance, and essential controls must continue. I would quantify restructuring costs, timing, savings, stranded expenses, and implementation risks under multiple scenarios. Finance should establish decision gates, track benefits against the approved case, and communicate changes clearly to affected stakeholders. I would involve the team in redesigning processes, retain critical knowledge, and monitor whether the new model actually delivers sustainable savings and better information. Mention business continuity, cash protection, scenario planning, stakeholder communication, change governance, role clarity, control preservation, transition risks, and measuring benefits after implementation. Question 19. How do you prioritize competing deadlines from senior stakeholders? I prioritize based on regulatory deadlines, liquidity or control risk, decision impact, dependencies, and the cost of delay. I clarify the required decision, minimum viable output, and deadline rather than treating every request as equally urgent. I then assess team capacity, delegate appropriately, and communicate trade-offs early. If two priorities genuinely conflict, I present options and consequences to the relevant leader instead of silently missing one. This approach keeps service responsive without compromising reporting quality or control. Talk about urgency versus importance, regulatory and cash consequences, dependencies, resource capacity, transparent trade-offs, expectation setting, delegation, and escalating conflicts with proposed solutions. Question 20. What would your priorities be in your first 90 days as finance manager at PKP? In the first 30 days, I would listen to the team, operational leaders, auditors, and senior finance stakeholders while understanding the close, forecast, control, and reporting cycles. By day 60, I would assess data quality, recurring risks, team capacity, and the largest performance drivers, identifying a few low-risk quick wins. By day 90, I would present a prioritized roadmap with owners, benefits, timelines, and measures. I would aim to build trust first, then improve predictability and efficiency. Cover listening and relationship building, close and forecast diagnostics, control assessment, team capability, stakeholder expectations, quick wins, key risks, data quality, and a practical improvement roadmap. If you are still with us, congratulations, You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.